Well, thank you so much, Vitaly, and good afternoon to everyone, if it is afternoon for you. Anyway, we want to turn to our perspectives, and I think hopefully you got a copy of the quarterly review. And now let me just talk a little bit about what it is we're talking, what we might want to do for the next few minutes here. So just quickly, a review of what I'm going to talk about. It's been a calm, in many ways, time period. I'm talking about the Fed and central banks, of course, and the recovery and the issues associated with what's going on with the central banks. And then I'm going to bring up a couple of additional issues like leverage strategy and financial intermediation and performance and so on. And we'll try to wrap up with the problem of presidential and other kinds of risks associated with the coming quarter here. So it's been an uneasy calm for this time period. The VIX was just slightly below 15 in July 1st. It's been below almost continuously since below 14, and occasionally it went at 11, and I think even during the day it was below 11.0 for a couple of days. Anyway, it was below 14 through September 9th, and then there was a spike. And there was another spike in on September 13. It's currently back to 13. It's been a strange time period of almost unearthly calm. And it has to do with, I think, a lot of issues associated with the fitfulness of this period. The U.S. remains the sole driver of global economic growth, although there's some signs that things might be changing recently. There's lots of hypersensitivity associated with the Fed by investors. There's clearly concern about the sustainability of economic growth. We have currently a very bizarre presidential cycle, and we have a lot of highly leveraged investment strategies implicit in the global economy and global markets, and yet the quarterly returns have been generally very positive. So what we saw during this period, in spite of the fact that people were very nervous, the returns were actually pretty well. It has to do sometimes with the people say bull markets climb a wall of worry. So there was a lot of things to worry about. Now, thinking about what's going on with the Fed, it's taken its foot off the pedal of quantitative earnings, quantitative economics stimulus for some time now. And that's the American economy currently has a lot of signs of robust economic growth. The unemployment rate is below 5%. We've had here in Massachusetts below 4% even. And we have unemployment, we have inflation rates, we have GDP growth, we have a fair number of things that seem to be just fine, okay? But what's going on with the Fed, there's a lot of interest, a lot of concern about global risk, not by U.S. risk, but global risk. So the vote in September at the Federal Reserve was to remain still not to raise rates, and there were 3 dissents. So most economists kind of think we're going to get a rate rise at the end of the year, but it's unclear that how people feel, and right now we're waiting for the unemployment data that's coming out and some more economic data and so on. At the international side, however, they're in the process of trying to stimulate their economy, not to try to put it back into a more normal state. And so almost all of the serious central banks in the world have a very aggressive stimulus program. And that the question here is just how effective they have been and how effective they are likely to be. Nevertheless, there's surprisingly enough some signs of positive effect in spite of all of the limitations associated with demographics and cultural issues and structural issues as well, especially in Europe, but also in China and Japan and in other places. So the index returns have been up this quarter, and maybe there's some signs that some of the stuff that's been working and that's been trying so hard to make it happen over there may be happening. Brexit is, on the other hand, another issue, and that is one that cannot be ignored because it is a totally, potentially very disruptive effect on the Eurozone. It's in fact kind of encouraging people to think in terms of maybe breaking apart the Eurozone. And of course it's the Euro that has to do with its viability. London itself has pretty serious issues, and the new Prime Minister is looking for a hard Brexit. So all of this is something to be concerned about, especially the impact on the Eurozone as much as the UK. Nevertheless, Europe is a very rich economic entity, and it's going to survive. It's just a question of how. Okay. So next is understanding the Great Recovery. So I think it might be useful to talk a little bit about this, just simply some background information, because we can't really understand what's going to happen without understanding what is happening. And the recovery certainly has been critiqued by many people in the U.S. and in other places, because the recovery has taken so much longer than it has in the past. And people have been concerned and critiqued the Bernanke monetary policies. Are they ineffective? Are they perverse even, because they are building certain kinds of debt for the country? But the point here is that modern macroeconomics has two levers. One is monetary policy, and one is fiscal policy. Monetary policy is by far the much weaker of the two. A monetary policy is meant to manage business cycles. It's not meant to grow the economy. Fiscal stimulus policy is what's happening, or people are trying to do in Europe, what is happening in Japan, and what is happening or attempts to happen in China and some other places. But we've only had a very small amount of stimulus policy during the last 8 years, at the beginning of 2009 and then 2008. So currently the Fed is the only game in town. And we have had no serious infrastructure spending due to the political stalemate in Congress. And as far as I'm concerned, and I think a lot of people feel this way, it's absolutely remarkable that the U.S. grew as much as it has for as long as it has, and as persistently as it has. The fact that it's basically been trying to run with the one or two hands behind their back, tied behind their back. Nevertheless, and I think the fact that the economy seems to be about ready to grow out and back to a normal state is essentially has to do with the robustness of the U.S. economy and the innovation associated with many wonderful businesses here in the United States. So international central banks, on the other hand, are almost stopped out. It certainly seems almost true in the European Central Bank. China has a number of political issues to deal with, and China has a lot of structural issues and demographic issues. So the monetary policies may or may not be reaching a limit. People are concerned with the unintended effects of very aggressive stimulus policies. We have a number of cases of negative rates in Europe and other places. And so there is a real need for an attempt to reinvigorate fiscal policies by members in the Eurozone. But of course, as you know, it's a disconnected political system, a disconnected banking system as well. And it's not a simple thing to do. A couple other observations. We've had a long period of predictable central bank interventions. And that has, of course, encouraged a very low volatility because investors kind of know what's going on and can predict it. So we've had low volatility in capital markets in many cases, although some fitful regimes in special cases. Nevertheless, Paul Samuelson called this kind of time period a desert flower period, which encourages many highly leveraged investment strategies. We don't have to talk about them, they're in the news all of the time. And these highly leveraged strategies, when they're not very stable, and when there is any kind of political issue, Fed issue, one of the governors talking about raising rates or whatever, there can be large intermittent spikes in volatility, which is, of course, exactly what we have been seeing. And there's a lot of levered strategy risk in the U.S. market. Another issue, let's see, the other issue is long-term rates, okay? The consequences of long-term low rates have to do with global financial intermediation. And you have a lot of financial institutions who assume that they have the long rates for funding liabilities will be available to fund their liabilities. Insurance companies, banking, of course, and pension liabilities. Pension liabilities often assume a 6, 7 or more funding rate, interest rate, and the long-term 30-year rate right now is 2.3%. So good luck to the pension plans funding their liabilities, and good luck to the insurance companies assuming that their life insurance policies and disability policies are going to be funded at a much higher rate than 2.3%. So there is a risk out here, and it's a very serious one, actually, about many of these large financial institutions even being able to commercially sustain funding their liabilities. And what really was going to happen here with a lot of instability associated with these continuously long-term low rates. It's a looming unresolved risk for global capital markets, something to pay attention to. And something else that people are talking about, of course, has to do with the underperformance of active funds. There have been some reports recently, the last 8 years, 90% of large cap funds, short and long term, have underperformed. Hedge funds are under the microscope these days. They have lots of high fees, although many of the high fees are starting to come down. But their long-term underperformance is really notable, even for many large institutions who can wait forever for being able to fund liabilities. Anyway, there's a lot of issues associated with non-standard equity, non-standard financial assets, or illiquid financial assets, and you can wait forever for something to happen, and if it's not going to happen, it can be really disastrous. Now, New Frontier strategies are all liquid. They're all liquid type of assets, things that you can cash tomorrow if you had to. These are all multi-asset strategies that live only for well-diversified index ETFs. And we rely on our quantitative expertise and patented technologies. This is real investing. It's not what will happen in the next 10 years. And these are all issues that have to do with what's going on with pension plans, with endowment funds, with foundations, and so on. There's a lot to be said for liquid, well-performing investments, especially for people who are mostly of you, like you, advisors, and with clients with retirement issues. It's the kind of strategy, I think, that makes an awful lot of sense, because you don't know for sure when people will need to be retiring, need the money. Here we have the money available to you. One last thing, I've said this before, but Gene Farmer has said this quite often. I think I remember hearing him say it a couple of times. He's a Nobel laureate, of course, as you know. Political risk is the single most important investment risk for all investors. Political risk can change the value of any kind of asset simply by legislation. The presidential election is clearly a joker in the global capital markets today. There are many possible radical changes that could happen very near term. Domestic entitlement, tax issues, military issues, geopolitical issues, domestic economic policy. there's absolutely no way to forecast a tumult that can result with some really fundamental changes. So, as we always say to you, the best way to manage risk is to be very, very effectively diversified. And currently, it's not a bad idea to be very well effectively diversified over the next quarter.